What's going on, guys? Welcome back to the channel. Today we're taking a look at Cisco. We're going to run the company through the stock research app and figure out what this company is doing right and what they're doing wrong, and finally figure out the intrinsic value of this business and what we should be paying for it today. We're grading this company a 7 out of 10. That's not a bad score. Based off their financial statements, the company gets either a point or a point deducted based off if they're doing something right or it's doing something wrong. That the price to earnings ratio is extremely high. 424 means you are paying a premium on average for this company. We want to find companies that have a price to earnings ratio ideally 22.5, 22.5 and below. You take a look at the trailing 12 months category of Cisco. It currently has that. If we can get that for the next 5 years or somewhere low to that, that'd be phenomenal. But trading at 17.75, that's something to keep in mind. That is a positive. However, the last 5 years have been pretty costly in order to buy this stock. Next, the current ratio is sitting at 1.45. Listen, 1.45 is not a terrible current ratio. The software is looking for companies that have a current ratio of 1.5 or higher. Now that indicates to us that they have enough assets on hand to cover their liabilities. That means that they're liquid. And in a time of a potential recession that's coming up, we want companies to be able to, let's say, carry out their assets over their debts, and so that way they can stay afloat in these uncertain economic times. Obviously, the software is going to deduct a point, but I can overlook that no problem. Where they are losing a point, and what I would say is a very much a key category, is the free cash flow. So the free cash flow growth is actually negative. It's at 0.65%. We want to see this number increasing over time. And now, to me, that is super important, especially now that you look at your revenue growth growing up as well as your net income also going up. It's kind of interesting to see that their free cash flow is going down. Now, what is Cisco doing right? Well, quite a bunch. Their return on equity average is sitting at 23.96%. That's pretty decent. We want to see companies above 15%, and they're well above that, so that is great to see. Their EPS is also up, so their earnings per share has also been improving over the last 5 years. The debt to equity is extremely low. This is great. These are phenomenal numbers, and this is something I like to see as economic times get a little bit shaky. 21% is great. We want to see numbers below 50%, so they're getting a point there. Well done, Cisco. Share dilution is actually, they've been buying back shares. I love that. Not a huge decrease in shares, but a decrease nonetheless. I love seeing that, so they're going to get a point there. Their net income is incredibly high. Their return on invested capital is also decently high at 18%. That is phenomenal. We want to see this number over 10%, and they're well above that. And obviously the revenue growth is up as well, but that is extremely low revenue growth. What is the one thing I'm looking at with Cisco? Well, the current ratio is the one thing I can forgive. The price to earnings ratio, yes, it is at 17.75. That could be forgivable, but however, this is if I'm looking at the company today, I'm liking this number a lot. This number is absolutely atrocious, and I apologize to anyone that has been buying this company over the last 5 years. You are paying a premium for this business. As well as the one thing that is concerning me, though, is its free cash flow growth. It's down ever so slightly, but that must mean that they are making somewhat of a consistent free cash flow over the last 5 years. There's still value in the business. However, we want to see numbers increasing, and this revenue growth, I mean, I don't know. I'm not too thrilled about this revenue growth. Regardless, we are going to factor this in going forward. We're going to put this into the price analysis section. We'll do a 10-year analysis. I'm going to fill out these lovely boxes, and we're going to figure out what this company is worth today and whether if it's a buy or not. I got to say, folks, my personal opinion, based on what I'm seeing here, this low revenue growth number, not a huge fan, as well as the free cash flow. Also not a huge fan in that regard as well. And I'll take a look at this. So on average, the 5-year free cash flow, this solves the mystery right here. $14 billion on average, the trailing 12 months, currently 13.23. So a slight dip from their usual average there. Not the best thing to see. However, they are up on a lot of key categories. Their profit margin is up compared to the 5-year margin. Anyways, with that in mind, I'm going to figure out what we should be paying for this company today. I'm going to fill these lovely boxes, do a 10-year evaluation, and we'll talk about it in just a quick second. So stand by. Folks, if you are enjoying the video so far, hit that like button and subscribe button. It means a lot to me. It means a lot to the channel. This software I'm using, if you want to get your hands on it, 7-day free trial, follow the links in the description box below. Also, right in the comment section, a company you want to see analyzed. So take a look at this. I'm going to go to the price analysis section and I'll tell you what we did. But on average, current price is $49.70, and we should be paying $33.16 for this business today. Now, if you want to know what I did, I like to try to stay as conservative as possible based off the low revenue growth rates that I'm currently seeing here in the financial evaluations. I can't assume this company growing incredibly quick over the next 10 years, especially with a recession just right around the corner. So that's why I did my revenue growth numbers very low based off what they've shown here. Like 10 years, that's 0.7, 5 years, 1.50. So I try to stick within these metrics as much as possible. Now with the profit margin, looking at their historical averages, I've done the same thing. I've given a slight haircut on the conservative side, as well as I stuck to between the 5-year number and the 10-year number, doing 17 and 18, as well as the free cash flow margin. Same thing. Try to be as conservative with some realistic expectations. Price to free cash flow and PE ratio, we have 15 for the price to free cash flow, 17 for the PE ratio. So I'm trying to find numbers that are kind of in there, as well as we hit the 10-year mark, the PE ratio should be coming down by a considerable amount, granted that as the company grows at a slower pace. So that being said, the current price of Cisco, as I said, is $49.70. $33 seems about right, as that would put us in pretty much in the middle to aggressive averages, just slightly north of the moderate average. I can't assume that this company is going to grow any quicker, as well as given the free cash flow situation as well. I'm not a fan. Anyways, that's the video. If you enjoyed it, and if you haven't done so already, hit the like button and subscribe button. Tell me what you thought about this evaluation. So far, Cisco a little bit overvalued, but if you think my conservative numbers are too conservative, pick up the software, put your own numbers in, and you can see it for yourself. Anyways, folks, I will see you in the next one. Thank you so much for watching.